Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week webinar for July 20th, 2023. Remember, trading futures involves risk and is not suitable for all investors. And everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you do want to talk to us about trading and what we can do for you for your futures execution, give us a call over here at Zaner at 312-277-0110. The rest of my contact information in the bottom right-hand corner of the screen there. This week, in the last 2 weeks, right, we've been witnessing a bit of a bullish reaction to weather markets in the grain across the grain spectrum. Most noticeably in the last 48 hours, we've seen some headline-driven reports sparking some interest in wheat markets. Let's actually start today talking about wheat, because it's got in the row crops, right? It's our odd man out right now. We've got reports out of the Ukraine and out of Russia of continued military aggression and escalation. But you have to wonder how, and you hate wondering and saying these things, but how much more can that really escalate, right? Port infrastructure in the Black Sea has been pretty much destroyed, right? Or you could assume it's destroyed. Certainly, any kind of ship traffic has been become null and void. So, okay, the market has had a couple days now of pricing that in, and for Chicago wheat, it's been a rally back in the September contract from the 650 area, the low end of the range that we'd otherwise been in for the month of July and certainly towards the end of June. But right back up to the highs there, towards the month of June, but failing, to break above that 200-day moving average at 746, and settling today back inside of yesterday's range. Not the best daily close, but it is a positive green close, at least there for the wheat, and it leaves us with at least a resistance level to consider for a longer term breakout as well. And we can take a step back and start looking at the idea that I could get a trend channel drawing here for us, that wheat is now trading lower in some form of a channel, and that channel resistance, right, coming in around where that 200-day moving average is, with support at this time, the support line drawn from the April 2022 lows through the lows here in May of 2023. You can see that we've just run back into that channel resistance once again. Okay, so below us, though, we've traveled back above the 55-day moving average, which is down around 657, 18-day here at 670, and the 100-day moving average just above that at 677. All of those look like they're going to be turning higher. So, another we'll be looking for the potential of that 55 over 100-day moving crossover, but we probably would also see the market break out above that 200-day and out of this range if and when that's kind of happening. But for the time being, we come out of oversold conditions. We trade back towards the high end of the range for wheat. We're not in oversold or overbought, conditions here for the daily RSI, but it's something to look out for Chicago wheat here in the near term. KC wheat, not much different in terms of the range we've been in, right? About $1.20 wide range here from the 760, 780 area. June and July, it narrowed up towards the $8 figure here before we, broke out above all four of those major moving averages that we watched. The 200-day now kind of holding a support in today's price action down at 851 3/4. We did make a higher high and a higher low for the day in KC wheat as well. We actually closed still within yesterday's range, but certainly above yesterday's close. And this chart looks like we're finding our way back towards the high end of the range, and at least today's price action looks like tomorrow, right, we'll have another shot at trying to take out those highs. That is assuming you don't break down back below today's lows, back below that 200-day moving average, and ultimately trace all of yesterday's effort that wheat made to get right back to the high end of their ranges. And it doesn't matter what wheat contract you look at, that news out of the Ukraine of damage to port infrastructure, as well as this escalation of Navy sword rattling that, all ships in the Black Sea are going to be considered hostile by both Ukraine and Russian military forces. Okay, just means the Black Sea region is shut down, right? And the market is pricing that in. How much more does it price in? Well, we didn't even get through, right, some of the big technical and range-bound levels that we've been in. Don't know. We go through it. We've got, I think, everything and all the means, right, excuse me, for a prolonged rally. But for right now, we've just rallied back to those resistances, right? And, well, they're the range highs for KC wheat until they're not. All right, so wheat today leaves us with another attempt, I think, into tomorrow for bulls to prove themselves. But how much longer are we going to wait for it to break out of these ranges? We'll see. We do have option expiration tomorrow. It's a weird option expiration, but nevertheless, those August options do go off tomorrow. And anytime you've got that kind of influx of participation for the market, you can expect more volatility and some excitement. So moving on here, it's going to be, I think, hard, though, for wheat to really rally if corn can't, get its act together, right? Not that the corn and wheat ratios can't, go bonkers again, because we've obviously seen those be big movers this year, right? We went from generally normal wheat to corn price ratio to the tightest we'd seen in 20 years, where corn and wheat actually went inverted for a brief period before, that, came back to, I guess you could say, some normalcy when, corn ultimately declined in price here into the end of June and certainly into May, but also as wheat found a bottom and started to rally, and there started to be a little bit of short covering from the very oversold wheat market that led to those extremely tight conditions. September corn, it's very similar to December corn at this point. I'd rather just concentrate on that new crop, even though, September is technically kind of an old crop contract. I think, right, we need to consider at the very least that there's almost no difference in, 10 cents in price in the market. And generally speaking, when you look at the charts, they're pretty much identical overlays of each other. Let's just concentrate on December corn, okay? At least that's kind of my opinion here. Anyway, and I'm sure here into the end of life for September, and if we catch different weather markets over the next several weeks and see different exports markets pick up, that could all change. But for the time being, right, the 50% retracement of this entire decline is my biggest concern for corn, and that comes in around the 555 area here in December corn. So that's from the highs, and we'll look at that on the 4-hour chart in a little bit, but at least on the daily chart you can imagine it's right around here in this 555 area. Okay, 200-day moving average is still above for December corn, up to 574 and a half. We are breaking above the 100-day moving average. Today was the day that we settled and closed for the second day and held the 200-day moving average as support, which was, basically right there around lows of the day at the 542 and 543 area. We broke above the 55-day moving average yesterday here at the 531 area, and that 18-day we're still well below it, or still well below us down at 518. But that's obviously starting to turn up, and as we know, right, these moves back above these indicators are, the first things that need to happen before markets truly reverse, or, right, you see, trends higher occur. And coming back down to test them as support as we find our way higher, that's not a bearish, development. If anything, that supports the argument that markets are trying to build into a bullish, right, rally, or build into a bullish trend. But they have to stay above them, right, once we've not found them as resistance, but want to hold them as support now. Those types of things help. Anyway, I am concerned, and we'll look at here in the daily chart the 50% retracement off the highs. That's a big technical level that you really don't want to see corn kind of stop at on the way back up. And just like wheat, we have to ask ourselves, right, what else feeds the bull in this environment for corn? We're pricing in that hot and dry forecast that we see coming for the next week. Particularly dry or hot at this point, right? Pushing to triple digit and certainly solidly into the mid 90s and upper 90s, all the way through the I states. At a key point in the year doesn't help, but if the forecast that follows that up after the 1st of August comes to fruition, well, we're going to find our way back. It's going to be like June to July transition all over again, where you have, that crappy condition at the start of that cycle, but then after 2 weeks, we find our way back into, mediocre and honestly, some pretty good weather, at least, at least comparatively so, right, in terms of where we started the year. I think we got a drink of rain in places at the 59th second of the 59th minute of the 11th hour there. That if had not come this week with this outlook and forecast would be a lot different, right? We would be talking about going to contract highs, I think, if we didn't get that weather system for the last several weeks at the start of July. All right, so anyway, but it did happen, and I think that's what's limited corn on the upside now, is that we know that we got that drink through that time frame, and that's what's limiting corn markets for the time being, right? Exports today were, better than expected, right? You're starting to see demand come in where you'd expect to see demand, right? When prices have dropped off of a cliff. And it's not just corn prices. This is where I'm going to segue for a minute into the dollar, because the dollar has fallen. And we like to look at the continuous chart here on the Dixie because this $100 figure is incredibly important. We cover it all the time in the strategy of the day and the week because as commodity traders and a commodity broker, I am fixated right on the value of our goods and services relative to the goods and services of other countries. And looking at the value of the dollar helps me gauge that. Because that is how we gauge the demand for those goods and services, particularly in this point, the commodities that we're exporting. So there's this old range that the dollar was in from 2010 through 2020, basically 90 to 100. We busted out of that range and have now fallen back into it. I mean, this looks like a textbook blow off top and a failure to break out of an old range and now a move back into it. We even put up a fight. Or the market price action put up a fight here between 101 and 100 and 105 or 106 for a period, and then over the last couple of weeks we have capitulated below. Now we are coming back up here in the last 48 hours of price action. The dollar has actually rallied, but we are going right back into old support, possibly now resistance. And the big question I would leave to traders today is, is today a sell in the dollar as we go back up into the 18-day moving average, as we test back up into this old support, now resistance? I think this is a technical reason to be a seller in the dollar on a move up, back up towards this area, right? For continuation of this trend lower, for failure to break out of this range, and honestly, for a swing move that could take you back down towards the 90, back towards the low end of this range. I mean, where's support for the dollar now, right? If it's not here, at old resistance, it was support. Now it's not. The next area for, of interest to me is down around 90. So if the dollar is going to lose 10% of its value relative to other currencies here, that's effectively a 10% coupon for, if it does that, right, for foreign exporters to come and buy our goods. And this trend lower will hopefully help encourage that over the next several months as we're looking for export markets to pick up elsewhere. All right, so let's go look at corn again in December. Look at just the daily chart real quick. Because we also shaved off, $1.20, $1.40 in price from the highs of June to the lows of July. So you didn't just see corn prices lose, or, you didn't see purchasing power abroad only gain purchasing power here in the U.S. to buy our commodities. You also saw corn prices, right, drop by this much. Not shocking to see exports pick up. In fact, if we didn't start to see the export market pick up a little bit, we should be worried. But hey, things are chugging along as you expected. So, I think that's also what's going to keep a floor in this market. Below $5 corn you start to ask yourself, well, are we not now starting to be so price competitive? Because, I mean, 480 corn versus 620 corn, you can do the math of what a percent decrease in price that is. I mean, it's, when you start talking 20 and 30%, markdowns, I mean, come on, that's massive margin increase for any corn user. And And of course, here we are at 546 and a quarter to settle the day because I think things got too cheap there. And we talked about the capitulation in corn here and the strategy of the day I did yesterday too. But let's break down what that looked like on the chart again, because I think it's an important little on the 4-hour chart here. It's an important technical reversal. But following this process forward also leads us into the concern of why 555 could be an area to watch. So corn was a big sell-off, right? We unwound that weather market premium, blah, 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 blah. We ended up finding the $5 mark in December corn and putting up this fight over $5. Couldn't break below 490 there, couldn't break back below 510 for about 2 weeks. We had the July WASD, sent us down to a 41 low. We capitulated. Market ran back up the entire range. In fact, this is kind of like an upside down dollar index, if you want, right? The 115 high on the dollar index is just like this 481 low in corn. And I'm anticipating, just like corn rallied through that 510 figure to the upside, I'm anticipating, dollar index falling below that 100 figure, that kind of neckline, if you want to call it a head and shoulders pattern of sorts. But falling, you catch where I'm going with that, right? It's a similar idea, just in the opposite. It's a failure to continue in one move. It's a complete reversal of that breakout, and then the market effectively setting up in a trend or going the other way, and retracing whatever move it made into that capitulation. So in this case for corn, right, we broke back above the multi-day range high. And in doing so, then we had, one pullback into 50% area, around test $5 again as support, and then boom, right on up into the, resistance of where we'd expect resistance to be at the 50% level off of highs. Going highs to highs on an extended long here, corn staying above the 540 area. It's kind of my line in the sand. It's a multi-day or intraday low and a low for today, around 542. So as long as we're above that 540 area, and I'm not saying we couldn't have a quick, move through it here tonight in the overnight and then continue higher. But as long as you're above that and we have an inside day, as long as we're above the lows here, we just look like we're bull flagging against resistance, and a push above 560 and the 563 highs here would take out, the invalidation levels for the shorts. And, then I would consider this leg up to be continuing in a bull trend, right? And you could almost put a channel of how it's behaving, but that's an hourly chart. Let's move, kind of want to look. Yeah, there you go. But nevertheless, full 50%, from the 41 low to the highs after, the 520 area where there's, that trend line below us would be an interesting support below. But this is a market that is finding support or resistance on the way up, holding support, finding new resistance, holding support, right? That is price discovery. It's not just one quick sell-off inside of a big range. So we're at least starting to see some, progressive dynamics, and it's not just volatility driving price action. But it's going to be very important, I think, for corn to pay attention to over the next couple of weeks, and whether or not that, high pressure ridge does bring that heat north. And if that sticks around, well, I think that's the narrative for how we get back to $6 and $6.20. If 2 weeks out, we don't get that cool off into August 1st and that rain again, and we just finish off the year with this hot and dry, the dog days of August summers are upon us. Well, if December corn could get exciting, and that's what's going to take us back to $6, imagine what that's going to do for soybeans in a market where we're already tight on the balance sheet, a lot tighter than beans. I mean, we're talking you shave just a couple bushels an acre off for national average yield, and you've already gotten down to pipeline. November beans here at 1404. Holding up a lot better and progressing, higher highs and higher lows, and where we are above, kind of the June through July timeframe range high of around 1375 to 1390. Doing a lot better than that August contract now, which has failed or, had a technical, kind of failure to break out of that level. Granted, we're still flagging up there, and I still think it will go, but August beans today. Falling back. I mean, you just look at a chart, right? You can see what I see in terms of the multi-day rally in November beans that still seems like it's going on. That in August beans seems to be faltering, right? So, 18-day moving average here, 1450 for the August bean, 1417 the 200-day moving average, 100-day down at 1384, 1357 there for the 18-day or 55-day, excuse me. Really haven't been overbought or oversold in beans since middle of June, so it's been a month since we've had overbought or oversold conditions really in this market, and we are kind of coming up into overbought conditions on the RSI, which all of these are all kind of warnings and foreshadowings for why we're a little concerned, that hey, Ukrainian and Moscow escalation, weather definitely turning hot and dry, no real rain in forecasts until August 1st. Like, if that wasn't the bullish news to get this market really excited, what is, right? We got to feed the bull to some extent. I haven't thrown in the towel. Everything's still, we got higher highs and higher lows in some places still. We have green closes. It's an inside day for corn. Today's could be a breath and taking a pause after what has otherwise been a pretty good run up for the last couple of weeks. That's all okay. So long as things don't totally fall apart or collapse from here, we can make the case on the charts for it all just being a technical pause. But it is, when we try to continue and find the narrative of why things are happening, to make sure that they're not, that they should continue happening, right? It's hard to find that going forward. So November beans, though, 1404 here and 3/4 in the close, inside day, but generally closing up in, above prior highs. It looks like a market finding its way higher. 18-day moving average is crossing above it at 200-day now, 1345, 1333 at the 200-day, 100-day down at 1289, and that 55-day at 1286. So you can see that 50 back into that we'll look at on the 4-hour charts has gone to its target. We'll look at where next support could be here on the daily chart, but also getting up into that overbought territory now for Novi beans, just crossed above that 80 figure in the daily RSI. So again, kind of, I always feel a little squeamish when markets start to show this kind of stuff, but I think there's a good cause and reason and rationale we can come to how and why they're still heading higher and where there's some support levels to consider still. All right, so 50% from 1351 up to 1504 on the August contract here. That's kind of the 50 back, and certainly I think the range support that we had, I think we've went sideways. We're trying to find a high. We tried to break out of that high. We really haven't broken back down because we're still, I think, trying to stay above old trendline resistances. But generally speaking, if it doesn't get going back above $15 here into the end of this week, I'm worried that August, has a lot of room down to 1420 again, because that's just the range we've been in and kind of failed to break out of. So it makes sense to retrace that range if it wants to. Could get as low as 1400, and you really can't discount all the way back for August beans at this point is 1357. Not saying it's going to go there, but gotta at least think about it. And we've been there before, and it was support before, so could be interesting. I'm really more focused on new crop also in the beans, just like corn, because it's holding up a little bit better. And that's also where I know balance sheet wise, and hey, even on this chart, I think there's a little bit more room to the upside, and there's plenty of room to unwind those old new crop spreads from earlier in this year too, which might actually be exactly what happens. So I don't know. We'll see. I don't want the daily time frame. I want the 4-hour time frame. Okay, so still very much, in my opinion, and apologize, there's a couple extra things in this chart I don't care to have on there. But the full 50 back here from 1130 lows up to the 1375 highs, traded around 1251, right? That's basically went up to its 1434 kind of swing target here already. I got a hunch it could still break out of that area, and it's still certainly, I think, in this swing higher from yet another 50 back that the market pulled. And a lot of these are just 2020 hindsight, but you're looking, the idea is we're trying to find the footsteps in the sand that other buying algorithms or other programs are making, right? And trying to discern how they're behaving, because we're never going to know before they do things how the market price action is going to behave. So we're always in a constant flux of trying to find out and track it, right? So 2 steps forward, 1 step back, 2 steps forward, 1 step back of two varying degrees, but you had 2 steps forward, 1 step back, and then another 2 steps forward into their target. One step back after that full target could take you down into the 1340 area. So where there's an upward sloping trend line, great. Next in the series here, because we did trade down to the 1320 area up into the new highs, got support around 1375. There you can see that fib was already on my chart there. But 1380, if we pull back, right? That's also just a test back to the old highs here, which, okay, that means if we're going to see a 30 cents lower in Novi beans, right? We just talked about how, how August beans might, not be ready to break out or had some capitulation and failed breakout. A 20-30 cent pullback in Novi beans, well, I guess it's 60 cents down there, but hey, that would just unwind the old crop, new crop spread by 30 cents while we're being bear spread. I don't know, kind of seems like something that could happen. So I am also watching today's price action, and from yesterday, August beans basically have just traded back into a 50% retracement from 15.17 highs to 14.82s. That $15 holding today was a 50 back off the highs. It could be the first selling, program trying to take this market lower. Of course, back above 15 invalidates all that. We'd probably run their stops. And again, those stops would be the exact reason we go to highs and through highs. And now all of a sudden we've got breakouts going on in November and August beans above the levels that we thought we were breaking down from, right? But that's, again, we just got to go off of what we see. And there's no reason that after breaking above 15 and getting all the way up to 15.17, that August beans really needed to pull all the way back here, but they did. So got to respect that. All right, let's shift our gears now. It's worth noting some other markets here in the, bean oil or the veg oil spectrum here. Canola having an absolute field day since May, the end of May, ended start of June, just pretty much straight up. So yeah, if canola, if bean oil, if things like that continue this type of rally, if crude oil rallies, it's going to be very hard for soybeans to stay down as well. So that's why I'm, not throwing in the towel here. I think there's some clear lines in the sand there in both bean and corn right now that could keep you bullish, and a narrative to continue to look for both of those. Another outside market here, but cotton, December cotton, breaking above 84 here today, getting as high as 80, almost 85. We're really starting to now get back into the high end of the range that we have otherwise been in since February of this year. But we are now, again, breaking above any sort of downward sloping trend line, right? So if this was any kind of sideways consolidation and maybe an A, B, C, D, E triangle, for those that like triangles or like to count wave structures in consolidation, I count a very, very compressed consolidated cotton market in December. And I can also go look at 100+ degree temperatures, from Oklahoma through Texas and beyond. I'm surprised that cotton isn't already at 90 or 95. But then again, I've been rather bullish on cotton throughout this entire consolidation since April. Hopefully now we finally, that's all coming to fruition. And I think that the weather in China as well is affecting that. And I think actually it's probably a good reason to think about, reassess the corn assessment too, is because we know, China's in the midst of a drought, and I think misproduction for their crops is going to matter, and start feeding into that global demand soon enough. But hey, dollar lower, cotton higher, right? Starting to all come together. We've been overbought here in the cotton contract, but I also think we are starting to break out of levels where we're going to squeeze that overbought condition a little bit here. But do look for tests back towards 82 to 81, to test this trend line support now is old resistance, now support. And as the moving averages start to, cross over each other, pullbacks to be bought in cotton if it happens. But I do think this could be the rally that finally gets us on our way back to 90 and beyond. But we will see, right? We still have old range highs, stemming up to 86 to 86, almost towards 87. Well, actually it is, I think 87 and 87.10 to break out of before, feeling like they've really overcome this price action. But, since April and since finding a new low down at 76 and expanding that little consolidation a little bit, I do want to point out that we are now back above, right, the old levels that we started that decline from. So this, to me, represents a complete reversal of that downward pressure. and cotton maybe starting to move a little higher. Lean hogs, the August hog back above 100 here today, gapped up above the 200-day moving average at 99, it's 97.99, and ran to close at 100.625, up 2.7 on the day. So not quite a limit up close. I believe that would have been a 3 or 350 close, but nevertheless for the hogs here, pretty good push, or maybe it's 4.5 now. Either way, actually, we can look at it right here. 4.75 is our daily limit. So, not quite, a limit up move, right? Not actually quite halfway there, but still an impressive close for lean hogs here in the August contract. That 18-day moving average, very clear support on the way up, 95.03 last, but probably going to be dragged up, for this current move. And if you thought that hogs were at any kind of disparity to cattle, maybe that script is starting to flip a little bit, right? We're starting to see now the price of pork and hogs come up, where otherwise we're starting to see a seasonality of a decline here in maybe beef prices too, as things start to get stagnant up at high consumer prices, getting it towards the end, pushing through a grilling season, right? Are we starting to price ration demand in cattle? August cattle down a point on the day, a little bit of a failure and breakout top coming off of overbought conditions here as well. Pushed up to a high for, let's see, where did we make a high today? Oh, I hate how these charts do that. Pushed above 183 here. Wow, for the first time since I don't know when, but if I go back, it's been a while. But a pullback now into the 18-day moving average towards 76 says it was an outside day lower. Would not be out of the question. Usually when we get one of these, kind of reversal-like structures, we like to come back to test those moving averages. So not saying you short it, but it's certainly, after tomorrow's progression in price action, this is certainly an outside day, reversal lower that could stem into, I think, a good reason to think about being a seller. Certainly if you're a producer, get locked in prices, give us a call. We'll talk about selling calls above to finance paying for some really close to the money puts here that could, put a really tight floor in if the market starts to get a little volatile and turn over. October cattle, 182.75, still holding that premium, but again, an outside reversal lower. Failed breakout here of the multi-day high here around 184. 18-day moving average still down around 180. If we break below that level, you're going back to the old, resistance high there. 173 to 75 below there, right? So you start breaking down the rainbow, and we come down to each one of these, you'll come down to find right support, and it's a long way down at this point. So just got to be happy with where it's taken us. Feeders have been putting up a fight for the last couple weeks here in the 250 area for the August contract. I guess the same here for September, really, but we've pushed through 250 a couple times, and this consolidation at highs is now, being pushed up against that 18-day moving average. So a break below this range with live cattle falling over, turning over. Look for the feeders to lead through the lows and support. We got open gaps here for the September feeder down around the 238 area. This island reversal, I would not be surprised to see them retest this area as support down around the 230 to 235 area. And then we all know, you start drawing support, the whole way down, it can go quite a ways. But I mean, just the range we've been in since, May, right? Finding 248, 232, then 248 again. We can go back down to 232 just because we know we've been up and down there in the last couple months. So we'll keep an eye on that. And this topping formation and my wall of worry that cattle continue to climb continues, I think, to build a little bit here. So, but in the near term, not much to report on the feeder cattle until you get below this multi-day low and below that 18-day moving average. Although live cattle, into tomorrow's price action, into the session tomorrow, look for continuation lower, as that could signal for a technical key reversal after an outside day candle lower here today. All right, so let's close the day out looking at crude oil, then gold, and a little bit of the S&P. September crude been going a bit sideways here for the last couple sessions, banging its up head against this downward sloping trend line we have against the highs that really comes in right around here around the 77 figure. The full 50% short from that 83 swing high to the 63 low. That was that 73 to 74 resistance area that I think we've now broken through. We're kind of consolidating a pullback here against that area now, broken resistance as support. So there's definitely something to be said for while you're above 74, we're still putting pressure on the 77, 78 area to break out of it. That opens the door to our next highs around 84, but really, I would say that would open the door when you take a step out to the daily time frame. That opens the door back above this trend line for a move back towards 90 and this more prevailing trend line from highs and that very big supportive area between 94 to 90 that held the market up through July of 2022 that we broke below, held as resistance, and then continued to kind of march lower all the way into that swing 50% from COVID lows to the highs after 50% area around 68 that the market took some time to chew through and has now come back down to test this support. And we've basically been finding this like kind of bull bottoming process around the 70 figure for months on end now. And we're just trying to wait for crude to get out of this range and trying to navigate the range as best we can. And some of that, for example, for right now is more or less just doing nothing and not necessarily trading it. But intraday, hey, we came back down to test old support now as resistance. It's bottling up. It's got a little bit of a bull flag while we're above 74. I think a breakout in the crude is probably above 78 is probably going to occur, or I believe it'll occur. But back below 74, we're just back into the old range that we've been in. And, well, there's not much to talk about when we're range bound. Gold at an old trendline support here, kind of broken, maybe now holding as resistance. We've also come down to test this swing from 1804 to highs. We hit the 61.8 line of that. That's no good. There's actually been a full 50% short now that's traded from the 2085 high to the low after around 1993. So got to watch that. If we roll over in the gold going down to 1850, well, that's basically, or that is down around where the full 50% swing from 1619 lows up to the high is after are. So going down to 1850 isn't, I think, a terrible thing and to think about for gold, but it is interesting to see it's still above this kind of downward sloping trend line in the near term. So I'm not totally convinced that we couldn't push above 2000 and back to 2020, but you really need to see that happen. Otherwise, down to 1850, I can't buy that personally, like in my own trading plan mentality. You can't participate on that level just on the first touch alone, but if we witness it holding and whatever, there's different small time frame things you can do to try to make a decision of whether or not you wanted to be a buyer there, because I'm concerned that if we start seeing 50% shorts hold off their highs going to target, if they're setting up in some kind of buy program on the way down, you end up with a decline like this, which is boom, 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 2 steps down, 1 step up, 2 steps down, 1 step up, 2 steps down, 1 step up. If we have 2 steps down and just 1 step back up, gold's probably coming all the way back down to 17 to 1650, just in this big range it's been in, right? So I'm cautiously optimistic that gold can still do it if the inflation trade really wants to take off. There's all these different things, but I think with the Fed being in a pausing cycle or part in the cycle where they could pause and what have you, that's certainly I think a big reason we haven't broken down, right? But at the same time, then why haven't we broken out, right? And why are you witnessing like 50% shorts holding, right? There's a narrative there, just like our row crops. If you don't feed the bull, markets are left just trying to find support. And last but not least today here, the S&P 500 continues with that breakout above that 4,200 area. We've now run up, and at this point, it's just a matter of running out of buyers and for how high the market wants to run. We've taken a turn back over here intraday, had a, now a lower low and a lower high for the first time in, like a few weeks. Seems like the type of run where it's just been up and up and up for too long and we need to see pullbacks, right? So old, resistance here, 4,500, couple days worth, and certainly the old highs from the month of June, I think are a logical place for us to maybe come back down and test. You can draw lots of trend line support, trend lines on the way up here that come in around 44 and 4,300. But some of the bigger levels to think about and the daily swings, right? Okay, if from COVID lows to the highs after was a big 50% level in a pullback. If we're starting to march higher, if there was a 50% pullback that we held, the market held from 4,200 down into 3,800, and it went to targets. There's now from a high to high extension, so from 4,200 measured up to 4,600, there's a continuation or an extended fib down around 4,400, and that's your first major level for the market, or to potentially look for a pullback. From 3,500 lows to the 4,600 highs, 40.55 is the full 50 back. And that would be, I think a retracement all the way back to test this old resistance, the cluster resistance between 4,200 and 4,000 that was holding the market back all the way through May of this year that we finally broke out of. It'd be a pullback to test, the old breakout levels, right? And certainly one to consider, but there's a lot of, I think, other support to chew through before we get there. But I think price action in the last 24 hours is, to me, starting to be pretty indicative of maybe some risk off in the near term, some profit taking, and otherwise, where's the next supportive area or where does the trend train stop next on its move higher? So again, 4,400 is a kind of a bigger level there on the daily time frame. Going down to the 4-hour chart here, that was our old swing. So from 43.68 lows to the highs after, again, 44.91. That'd be a 50% pullback of that swing. It's also aligns with those old highs from the month of June. Would be pretty much 50 back for the month of July as well. And then on the very short time frame, though, we're trading in a series here that 1, 2 has the first support around 4,500. And again, that's kind of, you see a cluster of highs here the last few days. Yesterday, or the day before yesterday, and yesterday we broke out of. Now we're coming back to test those old highs and that 50% area around 4,500. While you're above 4,540, expect to swing back to 4,635 and new highs for the month. Below 4,540, 4,500 becomes interesting. And again, that 4,400 area. So those are your short-term inflection zones to look out for, and the S&P on the way back down now. And then, of course, below all of those, we were talking major daily swings and reversal down to 4,405 or 4,400. So, or excuse me, down to 4,000. So that's a pretty big, would be a pretty big reversal, and probably a lot of other things to talk about before that comes to fruition. So, all right, we'll see how weather tames or otherwise these markets over the next couple of weeks. We've got dry, hot forecasts that have kept some excitement and probably are keeping a floor under the market for now. But if we don't see much to feed these bulls, or they don't get through technical levels, which can of course excite funds to cover shorts and do all these other reasons to see the market interaction. But seeing the market, particularly corn and beans, find resistance where they are, we can make a case for a path of least resistance lower in the near term, and a narrative that would justify that. So there's plenty to look out for and plenty to watch for. Thanks for joining me. That concludes today's Strategy of the Week webinar. You can always get in touch with us over here at Zaner at 312-277-0111 Zaner. You can find me on Facebook and Twitter. Email dhussey@zaner.com. Have a great day, everybody. Have a better weekend, and we will be back with you as price action develops. Take care, everyone.